Hello and welcome. You're watching KYC. I'm Hersh Sayta. With me is Mahima Vachrajani, and today we're going to be speaking with as well as analyzing an interesting company because that stock has just gone up 6% today on the back of Parag Parikh flexi cap buying 7% in the company. It's a 12,000 crore market cap company, and that's why, in fact, both Mahima and me are quite excited with regard to analyzing this one today because one, it's FMCG and therefore Mahima is excited, but second, I'm excited because Parag Parikh has just bought 7%, so works well. Okay, so that's how the setup is. But let me talk about what I want to know. And yes, Parag Parikh has bought 7%, but that does not mean in any fashion that you should too, and that's why we've tried to analyze this today the best we can. Let me first start off by understanding what's happening. One is you've seen raw material cost pressures, Mahima,
right,
due to which we've seen margin compression in recent years. Can that unwind? And management has guided for better margins going forward, but what are the levers and how much comfort is there is what I would want to understand. And again, we'll contextualize it by showing you the last 3 years' numbers as well and how the numbers have evolved. That will give you better perspective. But that's one piece I want to understand. The second one is, therefore, what the margin trajectory will be. They've said 2 to 3 years. They've said around 17 to 18% margins. Margins currently sit at 14%. Is it linear? Is it going to be an up and down? Is it going to be a gradual increase, and what gives them that confidence? We'll understand all of that. Also, can they hold on to market share? Most products, they have an impressive market share. You would have heard of a Nycil powder, the prickly heat powder. You would have heard of Glucon-D. They have large market shares in some of these products. So can they hold on to that large market share? Because once your market share crosses a certain threshold, it becomes difficult to maintain that.
True.
Really. And every new entrant will start chipping on to that market share. We've seen that in PSU banks as well, all those years ago, with HDFC doing that for over a decade. Now let's talk about the rural versus urban interplay. You've started to see a pickup in rural, and management commentary also suggests that. Does that mean lower margins for them as rural picks up? That's one piece. Second, what does that do to growth? So both of those levers is interesting. So growth expectations in the medium term. We've seen FMCG players demonstrate very sluggish growth. Mahima has been super disappointed for 2-3 quarters in a row. Want to see whether this one has something different in store. But yeah. Mahima, why don't you start off by describing everything about the company?
Right. So just to start with and give a perspective as to what the company does exactly, Zydus Wellness basically began its journey as India's leading consumer wellness company. It integrated basically the consumer company in basically the OTC market as well. It launched India's first zero-calorie sweetener, that is sugar-free, in 1988. Everybody knows the sugar-free brand per se. So Zydus Wellness is the pioneer of starting sugar-free as a brand.
Production team should have Katrina Kaif here because I'm not so sure as to why they have this background. Guys, if you are listening, this is not okay. But anyway,
okay,
so sugar-free.
Yeah. And considering the kind of distribution network that they have, you know, the reason as to why Zydus Wellness has done better than most of these FMCG companies is because they are very well penetrated in the rural markets, and they're also set to further penetrate in the rural markets. They've got roughly 1,950 plus distribution points, plus they have 6 lakh plus direct reach points as well. They're present in more than 2.8 million stores now. So that includes your large format stores, your quick commerce, your grocery retail stores. That amounts to a big number, and especially in rural areas. In terms of how their manufacturing capacities, at present they've got 4 manufacturing facilities that is spread across Gujarat, Uttar Pradesh as well as Sikkim. In terms of how the business segments are divided, they're divided into 2 parts, that is your food and nutrition and personal care. Food and nutrition includes your Glucon-D, your Complan, your Nutralite, sugar-free Amlite, and your personal care includes brands like your Nycil, Everyouth, etc. So these are basically the products, but Hersh, give us some perspective as to how the market share pans right now.
Yeah, so let's pull the previous, there you go. So no, so that's on the market rank. Yes, this is the market share. Just look at the market share of some of these. 59% is the Glucon-D market share in that product category. Nycil is nearly 34% market share. Some deep brands with some very good recall, and generally in FMCG that's what you want, right? You want large brands with very, very deep recall. If you really had to think of a powder, there are very few powders available, and you would go to the one which you have always gone to. And if Nycil is that powder for you, and was the powder for me at least, of choice, and therefore you would, the recall would always be to go to that brand which you've always used. Complan is the one pain point, as you can see, in terms of market share, just 4%. You'd want something, a bit of a fillip with regard to that number in terms of Complan. But outside of that, you look at Everyuth facial cleansing. Everyuth scrub has a 49% market share in the scrub market. And you also have Everyuth peel off, which has a 77% market share. So some very, very strong brands. And I want to quickly also highlight a couple of other brands. One is Sugar Free, which again has a very strong brand presence. And along with it, there's Amlite, which also has a very strong brand presence. And then there is Neutralite. If you recall, Neutralite within the butter segment, within the premium butter segment, has again very good brand recall. For those who use Amul, of course, that's big competition for Neutralite, but Neutralite is the other one.
Yeah, and in fact, they've very well penetrated in the restaurant business and your hotel business. That's where their major chunk of revenue for Neutralite comes from.
Yeah,
so that's
the hotel, catering and restaurant, that Horeca segment, they've done very well in. And then you have Right Bite, which they've acquired, which is Max Protein. Now again, Max Protein has such a strong presence. Nearly every chemist shop, every Kirana store has a Max Protein lying there in front of you. So great recall in terms of brand. And this one is poised for growth. That's one. And second, it's also got margin upside to it. They're currently doing single-digit margin on Max Protein. So it's in the growth phase. So that's one product you want to keep your eye out on as well. But those are all the brands that it owns. So a large brand presence for 12,000 crore is what I'm trying to highlight for you. Now, in terms of market rank, this is obviously as per company estimates, which is reflecting on your screen. It also has international presence. It has presence in the Middle East. Growth trajectory is good, targeting 8 to 10% of revenue in the next 4 to 5 years from international. And Sugar-Free franchise and Complan constitutes around 85% of the overall international business currently. So there's plenty of tailwind for other businesses to pick up. But let's start off with the key metrics and let's see how the company has done in the last 3 years. Let's start off by analyzing which metrics we look at for this company. We'll start off with the income statement. We'll look at the balance sheet, cash flow. We'll look at return ratios as well, shareholding, street cred, street coverage, and valuations. We'll look at all of those 8. I'll toss it to Mahima, income statement.
Right. So for income statement, in the past few odd years, in terms of the revenue, the CAGR growth has been 10%. But considering that it's an FMCG company, we've seen that all of these major FMCG players have equally not done very well when it comes to the sales CAGR. I mean, if you pick up something like a HUL or a Nestle or a Britannia, you'll see that the CAGR growth has been anywhere between that 4 to 5 or 6 odd %. Versus that, overall, Zydus Wellness has done well in terms of comparison to peers, but it still stands at a 10% CAGR growth. In terms of EBITDA growth, that has been just 3 odd %. So that is at par with how other FMCG companies have done. Margins have improved a tad bit in FY25 to that 14% mark, but there was a point of time when they were at that 17 odd %, but management has guided that in a couple of years they'll get to that 17% odd mark. And net profit 3-year CAGR has been around 4 odd %, which is also very similar to how other FMCG companies are doing. So just because it is not a very impressive growth, we've given this a thumbs down for now. But in terms of the overall segment growth, personal care has grown around 6.5% CAGR growth. 16.5% CAGR growth, and food and nutrition has seen a CAGR growth of around 8 odd %. It's interesting because food and nutrition for FY25 especially has not done well for most of these FMCG companies. I mean, you take something like an HUL, your Nestle, your Britannia, all of these companies have in fact seen a degrowth. In terms of EPS trends,
sorry, any reason why that is so?
I think it's just the demand that's not picking up. People are not spending on food because that is counted as a discretionary spending. So hopefully, I think Q1 and Q2 will see a better growth in the food and nutrition segment.
And with rural pickup, does this segment?
Not really. That's actually an urban segment that plays well when it comes to food and nutrition, because they are the ones who can spend more on healthy or better eating. All right. In terms of EPS trend, it's been a steady set of growth when it comes to the overall EPS growth. Dividend payout is also decent here, because if you look at the overall trajectory, it's been anywhere between that 10 to 12% every year for Zydus Wellness. This year also they've declared a dividend payout ratio of around 11%. So all of this is with regards to where income statements stand, but just because it's not as impressive as it can be, we've just given it a thumbs down.
Yeah, so margin recovery is something we'll await, but at the moment margins don't look as good, right?
Yeah.
The decline in margins is quite steep, from 17 to 14, sub 14%. So maybe that, and I just want to probably take a minute to explain dividend payout. Let's look at the dividend payout numbers. And thereafter, there you go. So that's the percentage, and that's the percentage, and remember those percentages, on the EPS. So you want to keep your eye out that this is not on market price, but it's actually on EPS. Let's pull up the EPS numbers as well, and that gives you a sense of what that dividend distribution number would look like, around 4 to 5 rupees a share roughly. But now let's quickly look at the balance sheet, and I'll keep this real quick. Very low debt, all of which is short term, around 100 odd crore, now 12,000 crore market cap, and therefore no concern there. Look at the cash balance, also quite decent, 75 odd crore of cash on 100 crore of short term debt. No concern with regard to that. Your other equity is growing nicely because you have your reserves and surplus, which is burgeoning, and therefore no concern there as well. It's trading at roughly 2 times price to book, and therefore not looking as expensive from a price to book perspective either. Cash flow, Mahima.
Right. So cash flow, we were discussing this earlier as well, and it's a good set of numbers. Where cash flow from operation has seen a good trajectory of growth as such. Even the overall cash flow to PAT, the ratio that we've seen has been on an increasing trend. It stands at almost 100% in FY25. Net cash flow, however, negative, but since Hersh and I were discussing earlier as well that because the overall operating cash flow to PAT ratio is quite impressive, the negative cash flows don't matter. So that's the reason as to why we've given a thumbs up to cash flow.
Yeah, but what therefore matters is your return ratios.
Correct.
Because what happens is your cash flow gets reinvested into the business, and what you want is your return ratios to be good, because if the cash flow gets reinvested into the business on high return ratios, it's incrementally good for a shareholder, which is likely you, and therefore you want a high ROC when you have all of that cash flow getting reinvested into the business. But doesn't seem like that. Look at the way in which cash flows have moved, or rather return ratios have moved, just about 6 odd percent, or between the 5 to 6.5% threshold. I'd like to correct the FY21 number. That's not 3%. It's probably 6.3%. I'll come back to that. But broadly, it's between that 5 to 6.5% number. So I'm going to quickly get to that. But broadly, not looking good on the return ratios count. Shareholding.
Right. It's a well-held company. It's a fairly well-held company. The promoter holding has gone up from that 66% mark in March 22 to around 69% mark in March 25. FII's holding have remained stable at the 3% mark. DI holding has slightly decreased from the 22% mark to a 19% mark. Public shareholding has remained stable at that 7% mark, and overall number of shareholders have also remained stable. But of course, the big news today is Parag Parikh getting into Zydus Wellness. An interesting fact out there that they were already invested in this counter around 2019. They did exit this counter around that time and moved this counter to their tax saving fund. But again, yesterday they bought around over a 7% stake in Zydus Wellness. So that's certainly a thumbs up, considering all factors, good, well-held company plus PPFS buying the counter.
Yeah, absolutely. I want to quickly go back to ROEs. The ROE number is 3% for FY21 indeed, as per Bloomberg estimates. So that number stands. I'm going to quickly look at how Street Cred has evolved. 6% 1 month, of course, excluding today's move. Negative 3% 6 months, negative 2% year to date, 5% 1 year. Not looking good across the board. And you also have a 5-year return of just 53%. That's obviously because of the financial numbers which haven't added up. The last 3-year numbers we showed you, and therefore you've seen the kind of street reaction over the last 5 years, not looking impressive, and therefore someone who's holding is definitely under some bit of pressure, and therefore street cred is a thumbs down. Valuations, Mahima?
Well, valuations is a thumbs up because, you know, if you compare it to other FMCG companies, Zydus Wellness is trading at better PE multiples, although not cheap at that levels also, but still, as compared to something like an HUL, Nestle, which is trading at anywhere between 60 to 75 times, Zydus Wellness is trading at 35 times, and it will further improve to 24 times in 2027 as per Bloomberg estimates. That compared to a Jyoti Labs, because it's a proper competitor of Zydus Wellness and within the same market capitalization as well. Still, in terms of the forward PE, Zydus Wellness PE seems to be more attractive than that of a Jyoti Labs, and which is why we've given a thumbs up where valuations are concerned.
This has changed because today we've seen a 6% stock move, and therefore please keep that in mind as well. Some of these numbers are as of start of day today. Last off, analyst recommendations and what the street how the street is viewing it. 5 buy calls, 1 hold call, 16% upside, maybe 10% now after the kind of move that we've seen. We've given this a thumbs up, of course, but nonetheless something to keep in mind because that upside has shrunk very, very sharply today. Let me quickly go through all of the metrics and give you the final rating. You're looking at income statement, which is thumbs down, balance sheet, which was fairly healthy, thumbs up, cash flow thumbs up, return ratios thumbs down, shareholding thumbs up, street cred, valuation, street coverage, that's how it sums it up, and 5 out of 8 on our KYC ratings. Let's go across. We had a conversation with Tarun Arora, who's the CEO at Zydus Wellness, to talk to us about how he expects the future to pan out. Listen in. Your margins have recovered from that low of FY24. Give us perspective. There's inflation in the system, of course. How is prices of both edible oil as well as dextrose monohydrate shaping up for you? Because that's kind of causing some bit of a drag. How do you hedge for that, and how much of that has been passed on in terms of price hikes?
So first of all, thanks for having me on the show, and I think Zydus Wellness has had a very good FY25, coming back on a couple of years of a lot of fairly high inflationary times that we were facing across multiple parts of our portfolio. So I think as things settle down, as we had a very good summer season and some of our categories really picked up, we've been able to overcome the inflationary pressures across certain categories, certain commodities. Oil has been fairly high. You rightly pointed out. Oil has been something which was looking better about a year earlier, and then it just shot up. It further got complicated when the taxes went up and the international prices also remained high. Of late, it's been a little bit more benign, more stable, and therefore we are quite hopeful that we will be able to continue to navigate it. Most of the costs we aspire, or the way we look at it, we are able to pass it on to the consumers in a calibrated way. Some of it we try to absorb by better cost management. So I think it's a mix of the portfolio so that we are able to deliver consistency on gross margin. Similarly, on dextrose monohydrate, which is basically based on corn prices, which have over last 3 to 4 years have been consistently moving up. We've been able to manage those costs through, again, better cost management on one side. On the other, we've been able to pass those prices because we are a market leader, and there is a pricing power that brands like Glucon-D and ICL have, and therefore the dextrose prices have largely been more than covered in our gross margin. So overall, our story from a margin perspective remains positive. There will be certain challenges which we may face because of summers not being good. So it may have a product mix on the portfolio, but brand to brand, we are looking at how do we ensure that we are able to manage our gross margins and continue to build it in a positive direction for our stakeholders.
Right. Mr. I just wanted to understand that in terms of your EBITDA margins per se, they've started to recover. They were at 17% in, let's say, FY22. They did go down to around 13%, but FY25 they did increase to that 14% mark. Just wanted to get a sense that from that 14% mark, what is the kind of trajectory that you're seeing for your margins? Let's say 2 years down the line, FY27, do you think you'll be able to come back to the 17% margin levels?
Absolutely. Our journey, I think we've talked about in various forums, including our investors, is that we want to get back to our 17, 18% EBITDA margins over the next couple of years. There are 2 or 3 paths that we believe that will help us get there. First of them is that gross margin expansion. So we believe that between FY21 and FY23, largely led by a significant impact on various commodities, milk, oil, practically everything went up. And most of the FMCGs we saw, gross margins came under pressure, and we were no exception to that. We've been able to consolidate and improve our gross margins, and there is still scope for building another 1 to 2% gross margins in next couple of years. Furthermore, if we continue to drive our growths ahead of our costs, I do see a scope for building an opportunity around operating leverage, which should help us improve our EBITDA margins and take it to closer to 18.
Mr. Arora, will it be a linear improvement? 2 to 3% odd from here, every year 1%? Is that the way one can look at it, or will it be non-linear? That's the first part of my question. Second, you seem to be confident that margins will recover. What gives you that? Are you hedging certain raw material price concerns in a certain fashion? Is that what kind of gives you the comfort, or how is it that you're so comfortable about this?
So the way I look at it is that if I go back to about 3-4 years when our EBITDA margins were higher, I think product to product, we've been able to largely cover up for the gross margin miss that we had because of the commodity pressures. And typically, most of the FMCGs, most of us will tend to respond to the cost because we are also conscious of high inflation impacts demand. So in my opinion, we've been able to price ourselves up enough to cover most of our costs. And therefore, I do believe that there is, as the product mix gets better, as we keep moving forward, the gross margins have that opportunity to move up 1 to 2%. So that's where I'm coming from. Also, most of our actions are focused on demand improvement, demand enhancement ahead of the industry. And therefore, if the growths really sustain that we want to, we should be able to get operating leverage. Of course, I have not accounted for any disruptions that happen which are beyond us, but those are something which you can't keep building, and there are risks every day. Today, there are more risks than a decade back because the kind of disruptions, geopolitics, and stuff that we are facing today, you just can't prepare for it. So you deal with it every day. I mean, 2 weeks back, somebody would have said, what is your view on costs? And I would have said crude is all sorted. So therefore, the oil prices will stay stable and we are sorted. Now, suddenly the crude has shot up. So those are things that you cannot build in. But from a medium term, we think that our strategy of volume-led growths, a strong pricing power, good capability to procure at a consistent level will all come together to deliver this. Beyond that, what happens from the environment point of view is something which we'll deal with as we face it day to day.
Fair enough, Mr. Arora. Just want to get your sense in terms of the demand outlook, because from what I understand is that you're more penetrated in rural areas, and that is something that is actually working for you, because none of the players in the consumption space have shown double-digit growth in terms of volumes, which you in fact have. So just want to get a sense as to how the strategy is working out for you. What's the next leg of growth strategy like? Will you be concentrating more on rural areas, because now we're expecting urban also to pick up in the second half of FY26, considering the tax cuts, the rate cuts that we have in play, the 8th pay commission. What is the overall demand strategy like, and what's the outlook like?
So in my opinion, I kind of agree with you that the opportunity is both in rural and urban. Rural, of course, has been several quarters been improving over the earlier year. Urban is also seemingly getting better. Better monsoons, government support will help move it forward. And we are believing that at an overall industry level, there could be at least 100 to 200 basis points improvement in demand. Though category by category, it may be different. For us, if I really step back and say, where are we going to be doing? I think we've got badly impacted by a very poor summer season, early monsoon, because we were quite optimistic on how this growth momentum will stay. But the current summers have obviously impacted our growth. But if I isolate this as a one quarter phenomena, I do believe that most of our actions are built towards a consistent double digit journey. On rural, we are quite positive, and we continue to increase our investments as well as our distribution. As per Nielsen, while our business is about 25 to 30% rural, our distribution is 50-50 as per Nielsen. Almost out of close to 3 million outlets that's we are available in, Zydus Wellness products are available in, half of them are rural. We continue to build forward also in this financial year. We'll further increase our small town and rural reach by increasing distribution. On urban side, while we are rejigging our distribution, because the demand is also shifting substantially on newer platforms like quick commerce, etc. So while we've done rather well on that, we've got almost over last couple of reported quarters, we've almost got close to a triple-digit growths on a small base because this is still building up. We believe that urban demand will behave very differently than rural. So rural will continue to build our general trade-led deeper distribution, more towns, wider reach. In urban, as the demand picks up, we are better equipped with new formats, new innovations, and omni-channel approach to cater to this demand.
Now, we're out of time on this one, but I also asked him on revenue growth, and this is the key metric, right? Can they continue to grow revenue? They said double-digit revenue growth, and let's have the KYC rating as well. But double-digit revenue growth is what he spoke about for the next 2 to 3 years at the very least. And therefore, even if a 10% growth is to be built in, you'll have the numbers likely because he's given us the margin outlook, he's given us the top line outlook. The company doesn't pay any taxes. That's the other thing you want to look out for. But completely out of time on this edition, taxes will get paid FY28 onwards. Completely out of time on this edition of KYC. From Mahima, myself, everyone who puts the show together, thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.